You're listening to Markets Radar with Jeremy Quintanilla, your home for everything markets, stocks, crypto, bonds, foreign exchange, private equity, initial public offerings, foreign markets, and everything in between. And I give you my take on what it all means. Thank you so much for joining in. And I just want to ask everybody if they could please like and share this with someone. This show is growing very, very fast, and I'm super excited for it. I'm almost a little bit afraid to take it off of this Age of Jeremy feed, but eventually it will become its own feed as we build out our Q Media production line on the Age of Radio Network and other places as well, because we are changing the game in multiple capacities, I guess. I don't know where I was going with that. But thank you all so much for listening to this. I am very, very excited, and I'm working to get this information out to everybody so that they can take sovereignty over their own wealth and their own investments. If you want to stay up to date with everything that I have going on, check out Age of Jeremy wherever you get your podcast. Join my Dope Insights and Updates channel, my broadcast channel. It's absolutely free on Instagram, continuing to build out that piece of my brand as well. So look forward to doing that. And I'd love for you guys to subscribe. The other thing that you could do is if you head on over to the Coach JV YouTube channel, I do a show on there every Friday at 12:15 Arizona time called the New Wealth Transfer Podcast. So please make sure that you jump into that. My friends, myself, our coaches, which are my friends, Jackie, Gonzo, Mario, May, and of course, Coach JV, we talk about things that are going on in the economy and in cryptocurrencies and the things that we have going on as well. That it goes live and then it goes out as a podcast. So you can also subscribe to the New Wealth Transfer Podcast wherever you get your podcasts as well. But let's get into the news today. And today that I'm recording this is August 18th, 2026. And the headline dominating Wall Street is a brutal collision between tech and bonds. There's been a sharp sell-off in chip makers, and it's pulled the major stock indexes down. And that is also as lingering bond market anxiety and inflation fears refuse to let go. The market is walking a tightrope right now. On one side, we have rising government debt keeping Treasury yields elevated. On the other, we have a semiconductor sector that has been the crown jewel of this year's bull run suddenly hitting a wall. Let's break down exactly what happened and why the bond vigilantes are waking up and what this could mean for your portfolio. Let's start with the hard numbers. The single biggest story is the damage in the semiconductor space. The closely watched gauge of semiconductor firms got absolutely plummeted today, plunging by 5.5%. Now, that chip rout dragged the broader tech sector down, pushing the NASDAQ 100 to a 1.5% decline. Meanwhile, over in the bond market, and we're going to go deeper into the bonds here a little bit later, but Treasuries barely budged today, but that is not necessarily good news. The 10-year Treasury yield is still hovering near its highest levels since early 2025. So what is keeping these yields so stubbornly high? There is an investment manager named Florian Lelpo at Lombard Odier, and he notes that we are seeing the investment hurdle rate rise again. But here's the catch. This time, it's not because investors expect the Federal Reserve to aggressively accelerate short-term interest rates. Instead, it's a toxic mix of rising oil prices, heavy government fiscal policy, and rising long-in-term premium. And speaking of oil, the energy complex is adding serious fuel to the fire. West Texas Intermediate oil topped $85 a barrel today. That spike is driven by geopolitical deadlock as the U.S. and Iran remain stuck in a high-stakes standoff over control of the vital Strait of Hormuz. President Donald Trump insisted today that there are currently no talks ongoing with Iran, leaving the conflict in limbo. As Elias Haddad at Brown Brothers Harmon points out, the upswing in oil is actively pushing bond yields higher and worsening an already fragile fiscal dynamic. Now, this combination of geopolitical turmoil and rising yields has investors deeply worried about supply shocks and government spending. Jonas Golterman over at Capital Economics explains that this bond sell-off reflects a growing demand by investors for greater compensation. They want to be paid for taking on fiscal, geopolitical, and policy uncertainty. Goldman warns that because governments are reluctant to rein in spending and pursue meaningful fiscal consolidation, while central banks find themselves constrained, the market is going to remain highly vulnerable to sudden bouts of volatility. Now, the big question is it time to panic? And with panic, we like hearing our jingle, jingle cash. It's just a little button right here. Oh, yeah. Nothing like a little cash register for fear. Veteran strategist Ed Yardeni says no. He wrote to clients that while his firm is not pushing the panic button, they are closely monitoring whether the legendary bond vigilantes might do so. Yardeni reminds us of the summer of 2023 when U.S. yields rocketed from 4% to 5% in just a few months. But then those high yields eventually became incredibly attractive to buyers and triggered a major turnaround. Yardeni believes a similar buying opportunity may be shaping up right now. But as Matt Mallet at Miller Topic dryly notes, higher interest rates doesn't matter until they do. That's why we need to keep our eyes glued to global bond yields as we head deeper into August and the fall months. Now, while the macro picture is tense, individual corporate stories are moving fast. Let's do a quick lightning round of today's key corporate highlights. You guys ready? We don't have a lightning sound, so you get one of these sounds. Cash register sound. That's our lightning sound. I don't know what that was. But first up, NVIDIA. Despite the brutal 5.5% drop in the broader chip sector today, Bank of America claims that NVIDIA might actually be trading at a massive discount of up to 50%. B of A urges that investors are significantly overstating the risk surrounding the undisputed king of AI chips. Next up, Anthropic, which we're going to be talking about later in today's episode, so make sure that you stay tuned. The AI wars are heating up. Anthropic's revolving credit facility is set to rise past its initial $10 billion target as the AI startup gears up for its highly anticipated IPO. Meanwhile, Meta Platforms is headed to court Tuesday. They are facing a major showdown with a collision of state attorney generals. The lawsuit claims Meta deliberately designed Facebook and Instagram to encourage compulsive addictive use among younger users. Makes sense. In retail, Home Depot delivered a major surprise. Their quarterly results beat Wall Street estimates. This is a massive signal that consumer home improvement spending is remarkably resilient, holding up even in the face of high borrowing costs and a tough housing market. But the consumer story isn't positive everywhere. Klarna has slashed its revenue expectations for the year. The buy now, pay later giant is feeling the squeeze from the foreign exchange pressures and weakening consumer spending in Germany, and they've announced plans to bring in a new CFO. And finally, Baidu is struggling. The Chinese tech giant saw its revenue fall for a fifth consecutive quarter, reflecting a weakening ad market and intense competition in AI development from rivals like Moonshot. And boy, do I know, that's the end of our lightning round. Ka-ching! Man, I really need to get more sounds. I don't even know if that wasn't even the right sound. Ka-ching! There we go. That's the right sound. Oh my gosh. Man, lightning rounds are fun. We should do lightning rounds more often. I need to get a lightning sound up in here. I just need to program that. And then instead of hearing a little ka-ching sound, you could hear whatever lightning sounds like, because I don't know if lightning has a sound. Maybe it would be thunder that you hear because the lightning strikes and the thunder roars. But anyways, that's what's going on across the market today. So keep an eye on the bonds. And if those bonds do become enticing for people to buy it because those yields are higher, that'll push more money into the bond market and then drive down those bonds as well. So something to think about. All right, now let's talk about the NVIDIA versus market paradox. If you subscribe to the Age of Jeremy, you'll be notified tomorrow. I have an episode coming out about innovation and project management. Is something that I'm personally working on. And that's what I talk about on my main Age of Jeremy episode that comes out on Wednesdays now. So you can check that out. But the reason why I'm bringing that up is because I do talk about NVIDIA and Jensen Huang's relentless pursuit of micromanagement and innovation, which is something to be admired to some extent. But today presents an incredible irony. The entire chip sector gets absolutely slaughtered by 5.5%. Yet Bank of America is out there pounding the table saying NVIDIA is trading at a 50% discount. This highlights a massive disconnect. Is the market correctly pricing in a macro slowdown, or is panic selling creating a generational buying opportunity in AI leaders? As it relates for NVIDIA, I think that NVIDIA is a strong contender for continuing to rise. I don't know if it's a 50% discount. I don't know what the price is off the top of my head, but if it is it is probably still selling at a discount in some capacity. Just like I also think that Google is sitting at a discount. I would say Google has the run to be even a better investment over the long term. In transparency, I own Google. I do not own any NVIDIA stock, but I do not think as of right now they are overpriced, but I'm not willing to say that they are at a 50% discount either. But I still think that from a long-term AI play, some of your best bets could still be NVIDIA and Google. The geopolitical pressure cooker. We cannot ignore the Strait of Hormuz, and we should also vote out Trump, but we're not going to go into that. If oil stays above, well, I guess vote out Trump. I guess vote out MAGA is what I mean. Vote out anything that has to do with MAGA and completely, I don't know, push those people to the side as best as you can as a political party. That's just my personal opinion. It's a faction that the GOP should not want. And even if I was conservative and a GOP, I would still be probably against that. But that's okay. This isn't a political show. This is a news show. But I guess all things are a political show. And it's my show, so I can give my opinion. If oil stays above $85, it keeps inflation expectations high. And again, it keeps the 10-year bond, 10-year elevated near those post-2025 highs. So as long as the Trump administration and Iran remain deadlocked, a geopolitical premium will keep bonds volatile. And I don't know where that's going to specifically end, but I'm assuming that however it ends, Trump will assume that it was a win for him, whether it was not. Or it was. The resiliency answer, if we look at Home Depot versus Klarna, the U.S. consumer has proven to be far sturdier than European consumers, particularly in Germany. It shows that high borrowing costs are painful, but they haven't completely broken spending on the home front yet. I do not want to see people I guess, use Klarna unless they absolutely have to. I would recommend not utilizing Klarna, and I think Klarna is going to be hurt in the long term as it relates to its purchasing ability. The only thing that I will say that Klarna might be beneficial for, but I don't know if they are the partner. Apple partnered with a pay-as-you-go company to manage the way in which they're going to be upgrading iPhones, where as new iPhone comes out, it'll just go on a pay-as-you-go plan, which is essentially like a subscription business where you can always have a new iPhone. I have a cosmic orange iPhone 17. I'm looking forward to an iPhone citrus color at some point in the future, but I don't know exactly when that's going to be in the future, but I would love to see one. As far as Home Depot goes, I believe that Home Depot could be a long buy. I started buying ETFs that relate to home building. I don't think that home building personally is going to slow down in the United States. Again, that's based off of Greg Abel, I think that's his name, the CEO of Berkshire Hathaway, as they went out and bought, I believe, Taylor Morrison Homes. And then they also put a large investment into Google. So those are some things that you could think about. We are in a fascinating macro environment where yields are driving the bus and tech is feeling the heat. So make sure you keep a close eye on that 10-year yield and those oil prices as we move through the week. And we will be right back with more. So besides the semiconductor sell-off shaking up the portfolios today, there is also the global fixed income markets. We talk a lot about higher for longer when it comes to central bank policy rates, but right now the market is taking matters into its own hands. We are witnessing a synchronized global bond slump that is pushing long-term borrowing costs to heights that we haven't seen in decades, as I mentioned before in the previous segment. Longer maturity bonds have become the absolute epicenter of investor anxiety. It's a mix of fears over persistent inflation, a massive debt-laden artificial intelligence boom, and governments that seem completely incapable of reining in their spending or taking care of the situation in Iran. Let's start here at home in the U.S. Yields on 30-year U.S. Treasuries have climbed nearly 40 basis points since the end of June, touching a staggering 5.33% on Tuesday, their highest level since mid-2007. We are back to pre-Great Financial Crisis levels of long-term borrowing costs. But this is not just an American story. If we look across the Atlantic in France, long-term borrowing costs have surged to their loftiest level since 2008. In Germany, the traditional safe haven German Bund yields are trading at levels not seen since 2011. In the UK, equivalent gilt yields are rapidly approaching the 6% mark. And in Japan, even with historically ultra low rate environment, similar maturity sovereign yields are creeping close to their all-time highs. So in all of these different countries, we are getting to our all-time highs of bond interest rates. Globally, the average yield on a bond market portfolio of investment-grade government bonds has climbed to almost 4.5%. That is the highest level in Bloomberg's compiled data going all the way back to 2015. And go get a Bloomberg subscription. This isn't a Bloomberg show. I just like them. So why is this happening? Why are investors demanding so much more yield to lend money to governments for several decades? There are three structural global forces driving the slump. First, persistent geopolitical turmoil. Surging energy prices, as I mentioned before, driven by the ongoing conflict in the Middle East with that asshat Donald Trump, have severely battered global debt markets this year. High oil prices keep fueling bets that the Federal Reserve and other major central banks will have to keep monetary policy tight for a lot longer. Second, waning demand. Changes in demographics and market structures mean that the once steady price insensitive buyers who used to gobble up government debt are pulling back. And third, and perhaps most critical, the total lack of fiscal discipline. Investors are deeply worried with major governments because they have no plans to rein in their massive spending deficits. As Skylar Montgomery Koenig, a macro strategist, points out, we are in a unique and dangerous environment of pro-cyclical fiscal expansion. In normal times, governments only run massive deficits when the economy is weak, which is usually accompanied by lower central bank interest rates that insulate the bond market. But today, governments are borrowing because they're asshats, borrowing massive sums when the economy is already strong and rates are already elevated, pushing yields even higher. And that's why the assholes that we have in office in the United States need to get out. Justin Onukwusi, Justin, Chief Investment Officer at St. James Place, summed it up perfectly. He said, what the market is saying is we expect greater inflation or at least greater uncertainty in the future, and therefore we demand a higher yield for longer bonds. And that is because we have such an uncertain future, because every time you turn on the fucking television, the person that's supposed to be leading the fucking country is saying one thing and then doing something else. That is my take. Now, the pain is already feeding directly into consumer and corporate loans. We are feeding into an incredibly important midterm election period with mortgage rates rising. This is a massive looming headache for asshat Donald Trump and Treasury Secretary Scott Bessent. And the cost of this debt is snowballing right before our eyes. In the US, interest payments on the public debt have skyrocketed to $1.17 trillion for the fiscal year to date. That is a staggering 15% increase, driven almost entirely by these higher yield treasuries. Governments are running out of options. In the UK, authorities have actually ceased most of their scheduled long-dated bond sales, trying to avoid locking in these painfully high borrowing costs for decades to come. But this is a temporary band-aid. You can't avoid the bond market forever. And I'm going to go on a little tangent here, because a lot of this is because most of the people here in the fucking United States don't want to pay increasing taxes. The only way to manage our money is, one, to get, I guess, fiscally responsible people in charge, one, or monetary responsible people in charge, and then two, you need to get more money into the government and make sure that they're paying those things. But the biggest thing that I hear from people, especially living in a purplish state, maybe a little bit more red state than purple state, is I don't want to pay taxes. People need to work for everything that they do. If I'm doing it, well, look, the world's not fucking fair. One, you did a great job. You should be proud. You're in a better position. Manage your money. Pay some taxes, help us pay this debt off, and then run for politics or make sure that the people that are in office are doing the shit that they need to do. That's the way that we should do it. We are all into this together, by God. And if we all have that attitude and we help the people around us no matter what and had compassion for them, we would be getting out of this freaking ridiculous debt trap that we are in. And it's going to take all of us working together and all of us just argue over the stupidest shit. Now, let's step back and look at the big picture here. The shock catalyst. Chris Ego, the CIO at AXA IM Core, made an incredibly sharp point in this Bloomberg article. Maybe this is a Wall Street Journal article. Pretty sure it's a Bloomberg article. Not 100% sure where I got this article. But he noted that it's hard to see what level of yield will finally make long duration bonds attractive to buyers. Again, he believes the only thing that will reverse the bond rout is either a sudden, severe weakening in economic data or an external shock. And he warned that an external shock is far more likely. This means we are navigating a minefield where a major geopolitical or financial shock might be the only cure for surging yields. The AI and debt paradox. Think about the irony here. Tech investors are bidding up artificial intelligence companies to astronomical valuations, like fucking Elon Musk, fucking X. But the sheer cost of building out the data centers and the energy infrastructure for this AI boom is contributing to the very government debt supply that is pushing yields up. The macro tailwind of AI is creating a massive headwind for the bond market. Then there's the election factor. With the midterms coming up, fiscal policy is going to take center stage. But with a $1.17 trillion interest bill already on the books, neither the Democrats or the elephant has a magic wand to wave this away. So prepare for a volatile autumn as budget season clashes with election season. We'll be right back. You know what we need right now? This is what this is what Anthropic AI is getting into. A little ka-ching. Really need to find another sound. Ka-ching. That's what Anthropic's getting into right now. A little ka-chingy, ka-chingy. A little ka-ching-ching. If you think the tech sell-off we discussed earlier means that AI boom is cooling down, you might need a little one of these. Ka-chingy-ching. We are witnessing an unprecedented capital raise that is setting the stage for what could be the biggest tech IPO in years. Fuck OpenAI. It's all about Anthropic and their ka-ching. Anthropic, the creator of the Claude chatbot, is in discussion to expand its revolving credit facility past a massive $10 billion target. Let's put that number into perspective, shall we? This is not just a standard credit line. This is a pre-IPO financial fortress designed to give Anthropic massive liquidity as it prepares to go public. It's a move that has Wall Street's biggest investment banks practically tripping over themselves to get a piece of the action. To get a little piece of this, little ka-ching-ching. Now let's look at the mechanics of the deal, the jaw-dropping revenue numbers behind it, and what it means for the upcoming IPO. Anthropic is currently working with Morgan Stanley, Goldman Sachs, and JPMorgan Chase on its upcoming IPO. To secure their roles in this massive public debt, banks are playing a classic capital markets game. Anthropic proposed expansion of its revolving credit line, known as a revolver, is drawing a clutch of Wall Street firms eager to bolster their pitches for roles in the IPO. Here's how the syndication breaks down. Anthropic has asked its most actively led banks to commit about $1.25 billion each. The next tier of active banks is being encouraged to step up with $1 billion, while less active roles, the little small guys, need to drop down $750 million and lower. Now, why would banks lend these eye-watering sums? Because it's what's called a syndicated loan. A higher commitment means higher fees, but more importantly, a higher rank in this credit facility almost certainly guarantees a more active and lucrative role in the actual IPO deal itself. This is exactly the same playbook we saw from SpaceX. Back in May, SpaceX expanded its revolver from $1.5 to $5 billion just 1 month before its record-breaking IPO. The bank lineup on the SpaceX credit line was virtually identical to the ones that ended up leading the IPO. Anthropic is running the exact same play here, but on double the scale. Now, you might be asking, how does a private startup justify a $10 billion plus credit line? Well, it's all just made up ass hat numbers, in my opinion. The answer lies in their financial performance, which they actually have some financial performance. It's nothing short of historic. By the end of July, Anthropic's annualized revenue run rate had hit a staggering $65 billion. And I'm happy to say that $20 a month, whatever that leads to $240 a year, has been my money that's gone to them. So some of my $240, that's a little bit of that's inside of that $65 billion. Now, according to internal documents, Anthropic brought in more than $11.5 billion in preliminary revenue in its latest completed quarter. To understand how astronomical that growth is, compare it to the same quarter in 2025, where they generated just $787 million. Now, we are talking about a company that has managed to scale its quarterly revenue by thousands of percent in a single year, while also reporting positive adjusted operating income for the quarter. So little Sam Altman, maybe you should take some notes from Dario. I can never remember this guy's name. I'm so sorry. I do like your product. With numbers like that, it's no wonder Anthropic is meeting with eager investors ahead of its mega IPO. They aren't just selling a promise of future AI utility, they are displaying a massive revenue-generated engine. But the capital war doesn't stop with the $10 billion revolver. Just a few weeks ago, a group of banks led by none other than Morgan Stanley were in talks to line up another $15 million in debt. And if the entire world runs on debt, and the US runs on debt, but all of us at home are taught not to run on debt, I don't know. Maybe there might be some benefits to using debt. I don't know. The key here is that this massive project managed by Nexus Data Centers is backstopped by who? Alphabet's Google, baby. The package consists of a $14 billion bridge loan and its own separate revolving credit facility. This means Anthropic is securing tens of billions in capital across multiple fronts, heavily supported by Google's balance sheet. So Google's balance sheet is helping fund Anthropic. So why the should you not be buying Google, just like Berkshire Hathaway did? And they are doing it to stay ahead of their primary rival, shitty OpenAI. Actually, I use OpenAI too. I use ChatGPT. The AI race has completely reignited the broader IPO market, driving total listings this year to $257 billion, the highest level we've seen since the peak of 2021. Both Anthropic and OpenAI have already filed confidential paperwork to go public, but Anthropic is currently expected to beat OpenAI because OpenAI is sucking. Sam Altman, get your shit together, man. Making its Wall Street debut as soon as this fall. Now, prepare. OpenAI has been building its own war chest. I don't have a war chest sound, so you know what sound I'm going to use? Earlier this summer, Bank of America handed OpenAI a $250 million credit line, joining an existing undrawn facility that boosted OpenAI's total available capital to over $5 billion. But with Anthropic's new credit facility cruising past the $10 billion mark, Anthropic is successfully positioning itself as a dominant heavyweight in the financial arms race. I'll be honest, I really don't know why I'm choosing to talk like this through most of this, but hopefully you're enjoying it, because if not, then I mean, where are we going to be? We're going to really need to get some more sound effects in here, though. All right, let's talk about the pay-to-play reality. What we're seeing with the $10 billion revolver is the ultimate pay-to-play mechanism on Wall Street. Underwriters like Morgan Stanley, Goldman, and JPMorgan aren't just evaluating Anthropic's business. They are being forced to put their own balance sheets on the line to win the IPO business. It shows just how desperate investment banks are. I should just end the period there. It just shows how desperate investment banks are to capture the massive feat that this historic AI IPO wave will generate. And this is just going to be the beginning of many. The $65 billion run rate reality check. A $65 billion annualized run rate is almost unheard of for a company that was in its infancy just a couple of years ago. But the fact that they reported positive adjusted operating income is the real game changer. I also will give Dario some credit for his integrity. I think that he can be a little pompous, but he's a PhD, so I'm sure all of them can be. I would be a pompous if I was a PhD in something. I'd be all pumpity pump over here. And so I have to give him some credit for his integrity and standing up to the government. And I think that also was smart, and integrity will never go wrong. And that's why one of my main principles. Something has to be compassionate. Something has to be integral. Something has to make the world better than I found it. And something has to build, protect, and grow my tribe. And if it doesn't do that, I will not do those things, right? You have to have a framework for deciding what you're choosing to do. And I give kudos to Anthropic CEO Dario. I think that's his name, Dario, for standing true to his integrity and fighting back against the piece of shit Donald Trump. It suggests that despite the massive multi-billion-dollar capital expenditures required to train frontier AI models, Anthropic has managed to find a highly profitable enterprise and consumer monetization engine, and Sam sucks. Google's invisible hand. So let's talk about this 15 billion Texas data center debt package. The fact that Google is backstopping it tells you everything you need to know about the strategic alliance in tech, which is a benefit here, but I'm going to tell you a problem with it in a second. Google is leveraging its financial might to ensure that Anthropic has the infrastructure to build the next generation of models, effectively tying Anthropic's success to Google's cloud ecosystem. This backstop takes a massive amount of capital expenditure risk off of Anthropic's balance sheet, but it then puts it onto Google's balance sheet. And so that's where the caveat is the fact that the more intertwined that these things become, it's just recycling the same amount of money over and over, and it's not new money that's actually being generated or created. Now, in this specific sense, I think that Google is doing it as a bridge loan. But the point is that the more that these things connected, the more likely it is if one of them falls, the other ones will get affected by it, and then those things bleed back onto Main Street after they maybe hit Wall Street. Wall Street will end up being okay. Main Street are the people that get hurt the most. Now, if we're looking at a potential fall blockbuster on Wall Street, Anthropic's massive capital push proves that the AI war isn't just fought with algorithms, it's fought with balance sheets. So again, keep your eyes on the confidential filing updates. I'm going to try to get into the IPO. I'm just going to be honest. I'm more excited about Anthropic going public than I am about SpaceX, especially since SpaceX tied everything to XAI. It's almost like SpaceXI is just an AI company now, and it should be a space company. That's my opinion. I also think that they should spin off their satellite division and do a different company altogether. But again, it's my opinion. And it's my show. So if you don't like it, you don't have to listen to it. And here we are. So we'll be right back. This is going to be a long show today, let me tell you. Especially with this sound. Okay, I will get new sounds, people. There is a sound thing that I can go and I can get sounds. Dustin keeps telling me I need to go sign up for it. I will do that today to get you better annoying sounds to listen to, because I'm the sound man now. I'm the sound man. In fact, when you think of Marcus Trader, I want you to think of this, because that's what we're bringing in, the ka-ching. Ka-ching-a-ching-ching. All right, it's going to be a long show because I also want to talk about Michael Saylor. Then I have one other thing that I want to talk about that I think is important for all of you. Michael Saylor in crypto markets. Yep, that Michael Saylor, the legendary executive chairman of Strategy Inc., is doing the unthinkable. He is running his Bitcoin accumulation flywheel in reverse. For nearly 6 years, the playbook of Strategy was incredibly straightforward. Sell common stock, issue debt, and aggressively buy every single Bitcoin in sight. It was a one-way street of hyper-accumulation, but a series of explosive filings culminating in the recent disclosures for the week ending of August 16, 2026, confirms that the never sell mantra has officially been replaced by active capital management, which in my opinion is okay because it ties into how his preferred stock is working. Over the last 5 weeks, Strategy has sold roughly 2.1 billion of common stock to buy back 347 million of its own stretch preferred shares and heavily fortify its cash reserves. Even more shocking for the purists, the company has sold over 213 million worth of Bitcoin during this period. What is going on behind the scenes? Why is the world's largest corporate holder of Bitcoin suddenly pausing its purchases and actively buying back its own equity? Now, the answer lies in a complex, highly engineered, and heavily debated mechanisms of Strategy's premier digital credit instrument, Stretch Preferred Stock. I'm going to demystify a little bit of that, how it fits into the broader Wall Street Journal and Bloomberg headlines that I found, and why this reverse flywheel might be a stroke of financial genius, or it could be a sign of systemic stress. Now, to understand how the Wall Street Journal and the Bloomberg headlines have put this, we first have to understand the instrument at the center of this battle, and that's Stretch, or their preferred stock, formerly known as the Variable Rate Series A Perpetual Stretch Preferred Stock. Saylor pitched Sailor pitch-built Stretch as a novel form of digital credit. So it's a NASDAQ-listed preferred stock with a stated par value of $100 per share. Unlike traditional fixed income securities or even strategies own preferred shares like STRF, which pays a fixed 10% dividend, Stretch pays a variable dividend rate that adjusts monthly. The entire security is engineered with a single specific goal to maintain a stable trading price as close to its $100 par value as humanly possible. And here is how that unique price difference system works in practice. So if Stretch, we'll call it Stretch, STRC, trades above par value, say $101 or higher, Strategies management has a toolkit to lower that dividend rate, issue fresh Stretch shares into the market via its at the time program, or even execute an issue or call option to redeem the shares at $101. If Stretch trades below par value at $99 or lower, the company can unilaterally increase the dividend rate to attract buyers, halt any at the market or ATM issuance below $99, or step into the open market as a buyer to repurchase the shares. Originally, a Stretches paid dividends once a month. However, this monthly cycle created a highly disruptive trading platform. Volatility and ATM issuance velocity would spike right before the mid-month record date. Now, this followed by a sharp drop in liquidity and a repeating 45-cent per share drawdown on ex-dividend dates that took weeks to recover. So to fix this, on June 8, 2026, Stretch C shareholders approved a historic amendment, shifting from monthly to a bi-weekly, semi-monthly dividend cadence. Now today, Stretch is the only corporate preferred stock in the rated universe to pay dividends twice per month, yielding 50 cents per share semi-monthly to hold an annualized yield of 12% on its $100 stated par value. Now, this bi-weekly cadence aligns perfectly with the standard U.S. payroll cycles and has successfully compressed the ex-dividend recovery window from weeks to mere days. But remember, despite being marketed as a Bitcoin-backed yield play, Strategy's own SEC filings carry a crucial warning that Stretch is not directly collateralized by Bitcoin. So holders, having no direct claim on the company's digital gold, they merely hold a preferred claim on Strategy's residual assets. So if this machine was so elegantly engineered, why did the flywheel break? Historically, Strategy used Stretch C and common stock as a one-way capital issuance funnel to buy Bitcoin. So the model worked flawlessly because Strategy's Class A common stock, MSTR, traded at a massive volatile premium to its net asset value, what the market calls its MNAV premium. So when MicroStrategy trades at a 2x or 3x multiplier of its underlying Bitcoin content, issuing common stock to buy more Bitcoin is highly accretive on a Bitcoin per share basis. But in early 2026, that music stopped because Bitcoin's price slumped to nearly $60,000. Strategy's massive cash flow mismatch was exposed. So the company's core enterprise software business generated a meager $122 million in quarter 2 2026. This resulted in an earnings per share loss of negative $24.45. So that software cash flow is fundamentally incapable of servicing Strategy's massive preferred dividend liabilities, which exceeds $640 million annually across its various preferred stock classes. Preferred investors grew highly anxious, except for me because I just kept buying. A class action law firm probe launched on June 25th sent shockwaves through the preferred tiers. Concurrently, Strategy's paper losses on its Bitcoin holdings ballooned to $8.9 billion. Again, those are paper losses. Under this compounding weight, Strategy's MNAV premium compressed towards 1x. At a 1x premium, issuing common stock to buy more Bitcoin is no longer accretive. It is dilutive. So even worse, the trading price of Stretch collapsed, hitting a 52-week low of $71.25 in June. Now, if Stretch trades as a massive discount, Strategy cannot issue new preferred shares accretively to fund more Bitcoin acquisitions. The entire capital raising machine got locked up, and Saylor was forced to adapt, giving rise to the Digital Critical Capital Framework in June 29, 2026. This new framework eventually marketed Strategy's evolution from a simple Bitcoin accumulator to an active balance sheet hedge fund. So under this playbook, Strategy is playing a highly sophisticated capital recycling game. First, they authorized up to $1 billion in repurchases of their own outstanding digital credit securities, prioritizing Stretch. During the week ended August 16, 2026, Strategy aggressively executed this play, buying back 1,388,720 shares of Stretch C for $132.2 million in the open market. Why is this a brilliant move? Because Strategy is repurchasing Stretch C at a steep discount to its $100 par value, averaging around $86.52 per share during the early stages of the program. By buying back Stretch C below par, Strategy permanently retires a 12% annualized dividend liability at a discount, capturing that spread and actively boosting the Bitcoin per share metric for common equity holders. Second, the framework established a formal USD reserve policy. So management is mandated to maintain a cash reserve equal to at least 12 months of expected preferred dividends and debt interest obligations. So to build this buffer, Strategy aggressively sold $333.7 million of common stock via its at the market program in the week ending August 16th, pushing the total USD reserve to a historic high of $4.8 billion. This reserve now provides 2.8 years of aggregate coverage, completely isolating preferred holders from near-term price collapses. But how does Strategy fund these buybacks and dividend obligations with MicroStrategy equity sales taper? Enter the BTC monetization program. So the board authorized selling up to $1.25 billion in Bitcoin to fund or replenish the USD reserve and support preferred repurchases. So in early August, Strategy utilized this program, selling 1,690 Bitcoin to roughly $108.6 million to direct the proceeds towards Stretch C repurchases. And here is a clever accounting detail that the market is actively interpreting. What Bank of America and Bankless analysts call the build versus replenish loophole. When Strategy sold the 3,588 Bitcoin for $216 million in early July to fund dividends, they classified it as a replenishing the USD reserve rather than building it. By using this distinction, the company keeps its headline $1.25 billion reserve building capacity completely untouched, leaving themselves with billions of dollars in hidden liquidity runway. Okay, so that was a lot of information. So let's step back and address the billion-dollar question. So if Michael Saylor is Michael Saylor trapped in a house of cards, or is this an ultimate masterclass in financial engineering? Okay, so let's talk about the war within the capital structure. As macro analysts Jeff Dorman and Matt Walsh pointed out, the major problem with Strategy's new playbook is that every part of the capital structure is now in a quiet war with the other part. What is highly positive for one tier can be actively negative for another. So for instance, issuing MicroStrategy common stock to fund Stretch preferred dividends and cash reserves protects the preferred holders peg. However, continuously issuing the common equity at a press premium dilutes MicroStrategy shareholders and caps the stock's upside. But if you dilute the MicroStrategy shareholders and caps the stock's upside, you could find some benefit in looking into, I'm not going to go into it here, go do your own research, into yield max ETFs such as MSTY and or Winter. But that's for you to go figure out what I'm talking about. Peter Schiff versus the S&P divergence. So we have a fascinating clash of narratives. On one side, gold bug and persistent Bitcoin critic Peter Schiff has threatened lawsuits, calling Stretch structure misleading to the point of fraud, and warning that a severe Bitcoin crash will make dividends unsustainable. On the other side, S&P globally recently assigned Strategy a B- credit rating with a stable outlook. While S&P actively flagged Strategy's severe asset liability mismatch and negative total adjusted capital under traditional frameworks, they validated the model by acknowledging Strategy's unprecedented, robust access to capital markets, which is 100% true. The never sell illusion is shattered. The most profound takeaway from this pivot is philosophical. The pristine narrative strategy as a one-way never sell Bitcoin black hole is officially dead. Bitcoin is no longer an asset strategy. Just accumulates into perpetuity. It has been actively transformed into a balance sheet lever to keep the preferred stock debt stack functioning. While Saylor has defended his actions on social media by saying they expect to remain a net buyer over time, the reality is that strategy has become an actively managed, highly flexible corporate hedge fund, and I agree with that as well, especially with the creation of the different financial instruments that they have. It's just that their main asset that they're holding is going to be specifically Bitcoin. So at the end of the day, strategy is no longer a simple proxy for levered Bitcoin exposure. It's more of a complex institution that the market must actively interpret. Every single word in their regulatory filings, build, replenish, issue, repurchase, defend, now carries the same weight as a Federal Reserve policy meeting. So whether strategy can successfully balance these competing capital tiers without one breaking the other remains the ultimate $1 million bet of 2026. But what I want to say right now is I am still buying Upstretch. She is part of my dividend portfolio. And you sometimes talk about my dividend portfolio in my Instagram broadcast channel, Dope Insights and Updates. So you can go, or Dope Updates and Insights. You can go and subscribe to that, and I talk about that, but I'm always transparent about what I'm buying. I am very interested in the financial instruments that Michael Saylor and Strategy is creating. Do I think that they will all be winners? No. Do I think that it was ridiculous of him to say that they're never going to sell their Bitcoin? Yes. I think it's ridiculous of anybody to say that they will never sell their Bitcoin, including my own business partners that say that they're never going to sell their Bitcoin, because of the fact you don't know what's going to happen into the future. There could be a situation, just like in Michael Saylor's situation, where they put themselves into a position that required them to sell their Bitcoin that allowed them to be in a newer position. And that seems more fair than being an absolutist in regards to what you're doing with any type of cryptocurrency, with any type of investment. You should never be, in my opinion, married 100% to any type of investment, because even though there's truth in the project now, there's truth in the ability of it, that's one of the main core functions that I'm finding out of pragmatism as I go and study it more, is that as new information introduces itself, that information should be utilized to validate the truth of what it is that you believe. And if that data does not validate that truth, then it's okay for you to change what your belief system is. And there is nothing wrong with that. And as I always say, we'll be right back. I was going to say be thankful, grateful, and kind, but we got to talk about war in Asia, on the other side of the planet from where I'm at. I was really trying to get this to ka-ching. I was really trying to get this to only be about a half an hour today. Man, there's so much fun news going on in the world when you're trying to cover markets. It's almost like you should have just maybe for some of the countries, just one markets radar show. Is there a light bulb there? I don't have another sound, so you get, and that is what it is. As we prepare to close out today's episode of Markets Radar, I want to shift our gaze from the balance sheets of Wall Street to the high-stakes maritime borders of East Asia, because war affects markets like there's no tomorrow. For global investors, geopolitical risk is no longer just a headline you skim. It's an active variable in every risk model. The Western Pacific is home to the world's most critical semiconductor supply chains, the most vital maritime trade routes, and now two massive military shifts that are redrawing the security landscape of the first island chain. Over the last 48 hours, we have seen a stark divergence in defense dynamics. On one hand, President Donald Trump has blindsided Seoul by ordering dramatic unilateral cuts to long-standing U.S.-South Korea joint military exercises because he's an asshat. On the other hand, Taiwan is quietly executing a highly aggressive lethal transformation of its Coast Guard, effectively weaponizing its law enforcement fleet to prepare for a potential blockade or invasion by China, who can be asshats. These aren't isolated military events. They are structural changes that carry massive implications for global trade, shipping insurance rates, and regional deterrence. So let's break down some of the friction starting over in the Korean Peninsula. Let's look at the sudden shockwave that hit Seoul. On Sunday, on the very eve of the scheduled 11-day joint military exercises known as Uichi Freedom Shield or Ulchi Freedom Shield, President Trump took to social media to announce a substantial reduction in the drills. Ulchi Freedom Shield is a vital defensive exercise involving over 18,000 South Korean troops, designed specifically to train for North Korean drone incursions, cyber attacks, and amphibious assaults. Yet the president ordered Secretary of War Pete Hegseth, who's a dick, to cut them back. His reasoning: first, Trump argued that the exercises are costly and that the U.S. pays too much on that bill. That's where we're deciding to make the cuts. What an asshat. He has long complained about the cost of maintaining the 28,500 American troops stationed in South Korea. Yes, because we need to have them in Iran. Demanding the sole pay up to $10 billion a year, a massive spike from the $1.1 billion agreed upon under a recent 5-year cost-sharing deal. 5-year cost-sharing deal, that sounds fair. Second, Trump cited his very good relationship with North Korean leader Kim Jong-un, claiming the drills send a hostile signal. Out of all of the countries that are actually dictators, there's a major commercial leverage point at play here. Trump explicitly criticized South Korea for not sending warships to assist the U.S. in the Middle East. And just like a fucking child, when someone who doesn't want to play with him or help him, they automatically become his enemy. Yep. So again, you know my thoughts on this. The Trump administration has been aggressively pressuring countries that rely on oil transiting through the blockade Strait of Hormuz, including South Korea, to send their own naval assets. Secretary of State Marco Rubio recently met with Seoul Korean Foreign Minister Cho Hyun in Manila, pointedly noting that South Korea has unique capabilities in terms of mine clearing and that participating would be their benefit. While South Korea's Blue House has politically responded they are carefully reviewing the request under their domestic laws, this sudden cut to their primary defense exercise is a clear transactional warning from Washington that if you don't do what I want, then I'm not going to do what you, if you don't do what I want, then I'm not going to do what you want. And I think that that is a very archaic way for diplomacy. Now, let's pivot south to the Korean Strait. With the U.S.-South Korean alliance is feeling transactional friction, Taipei is taking its security entirely into its own hands. In a groundbreaking report, the Wall Street Journal revealed that Taiwan is rapidly expanding the role of its Coast Guard to deter a Chinese amphibious invasion. The strategy is simple: turn white-hulled law enforcement vessels into lethal secondary naval assets. Just this past week, during Taiwan's annual 10-day Hong Kong military exercises, the Coast Guard participated in an unprecedented 33 drills. In Kaohsiung, a Coast Guard cutter led missile boats, mobile radars, and drone launches in a simulated invasion defense. Even more striking was a drill off Taiwan's east coast featuring the Bali, a 213-foot fast response Coast Guard cutter. The Bali joined naval forces to practice escorting a commercial merchant ship through a mock Chinese blockade, a critical scenario given how dependent Taiwan is on energy imports to survive an attack. And the Bali is no longer just carrying a water cannon. It is engineered to be loaded with Taiwan's highly lethal Hsuong-Fang 2 subsonic and Hsuong-Fang 3 supersonic anti-ship missiles. Those are cool names. Let's look at these missile specifics. The Hsuong-Fang 2 travels up to 650 miles per hour with a range of up to 75 miles. I wish I had a rocket sound, but I have one of these. The Hsuong-Fang 3 is a supersonic ramjet beast flying at up to 1,405 miles per hour with a range of 93 miles. Taiwan has 12 of these 213-foot cutters as part of a 10-year, 141-ship fleet expansion plan launched in 2018. In wartime, these ships will fall directly under Navy command, giving Taipei a highly distributed, difficult-to-target missile fleet. As Ian Easton, an associate professor at the U.S. Naval War College, pointed out, the key will be training these traditional law enforcement crews for their wartime jobs. Because right now, China is aggressively using its own massive Coast Guard, the largest in the world, by the way, to pressure foreign commercial shipping and squeeze Taiwan's maritime borders. So if we step back and put these two puzzle pieces together, what's the real story here? Well, there's a transactional alliance risk. The decision to scale back Chi Freedom Shield is incredibly short-sighted. As Patrick Cronin from the Hudson Institute noted, the U.S. needs South Korea as an ally more than ever, not just for military deterrence, but to secure our supply chains in critical sectors like shipbuilding and semiconductors. Punishing Seoul for resisting any risky Middle Eastern deployment undermines the very security architecture that keeps global tech supply chain stable. Also, if you have an agreement with a man, you still need to do that agreement with that man, even if though another agreement with that man is something that's not going to be done. You should keep to your word, and that's integrity. And Donald Trump doesn't fucking have any. The new nuclear dilemma: by watering down joint drills, we are weakening our extended nuclear deterrence guarantee to South Korea. The U.S. has spent 3 years trying to dissuade Seoul from developing its own nuclear weapons. If South Korea feels they can no longer rely on a transactional Washington, the pressure within Seoul to build their own independent nuclear deterrent is going to skyrocket. And on top of that, we know North Korea has nuclear weapons, yet we're okay with them having them, but nobody else can have them. The second Navy reality: Taiwan's militarization of its Coast Guard is a highly logical, asymmetric response to China's gray zone warfare, but it also signals that Taipei knows they're a ticking clock. They can't afford to wait for a crisis to occur. So if regional alliances fracture under domestic political pressures in the West, local powers will increasingly resort to rapid independent militarization. And this is the new fracture normal for global maritime logistics. So the takeaway from markets is clear. The risk premium in East Asian shipping lanes is going up, not down. Whether it's the Strait of Hormuz or the Taiwan Strait, the friction over who pays for and who polices global maritime checkpoints is intensifying. When you look at companies dependent on TSMC's advanced nodes or global container shipping, these defensive drills and alliance fractures are the leading indicators of tomorrow's supply chain disruptions. And again, this is a first look on Markets Radar today in what is going on in Asia. Because again, as I always say, as soon as China makes the move to attack Taiwan, that is when we, in my opinion, will probably officially be going to our World War III. So on that happy news, as I always say, be thankful, grateful, and kind. And we'll see you soon. Bye.